dear students, to the massive open online course on money and financial markets. In today's module, we are going to learn about the financial markets, about their role, classification, and market participants. The objectives of this module are as follows. We are going to learn about the three very important economic functions of financial markets, the various ways in which the financial markets are classified, and also we are going to have a brief overview of the market participants. Now, the international financial system exists to facilitate the design, sale, and exchange of a broad set of contracts with a very specific set of characteristics. We obtain financial resources through this system directly from the markets and sometimes indirectly through various institutions. Before we go further, we need to understand the meaning of the terms indirect finance and direct finance. Now, indirect finance means an institution stands between the lender and the borrower. So we get a loan from a bank or finance company to buy a car. So this is indirect finance because a bank or an institution stands between the lender and the borrower. And when we talk about direct finance, the borrowers can sell the securities directly to the lenders in the financial markets. So direct finance basically provides financing for the governments and the corporations. And certain other terms that we are going to use in this module are assets and liabilities. Assets are something of value that we really own. You own, that's assets. And liability is something which you owe to somebody, that is your liability. Now, when I talk about financial development and in economy, the most important aspect of it is the relationship between financial development and economic growth. The role of the financial system is to facilitate production, employment, and consumption. Resources are funneled through the system, so resources flow to their most efficient uses. And we need to keep in mind that the financial system comprises mainly of the financial instruments or securities like stocks, bonds, loans, insurances, like financial markets, like we have the Bombay Stock Exchange, the New York Stock Exchange, the NASDAQ, or financial institutions. So here, students, can you explain the mechanism by which funds flow through the financial system? Now, as you can see in this slide, we have the total mechanism by which funds flow through the financial system. Here you can see the very two concepts that I explained just now, the concepts of direct finance and indirect finance. And we have two institutions. We have the financial markets and the financial institutions. If you look at the other two boxes, we have the primary households who are basically the lenders or the savers. And we also have the borrowers and the spenders who are mostly the governments and the firms. Now, if you see the inner loop in this diagram, you will see that funds basically from the households enter the governments and the firms, are utilized rather by the governments and the firms through the financial institutions and the financial markets. So financial markets basically deal with the direct finance, while the financial institutions basically deals with the indirect finance. If you look at the outer loop in the diagram, you will find that funds from the financial markets with the help of the financial instruments gradually enter into the primary households, and also from the governments and the spenders, the borrowers and the spenders, the funds also enter through the financial institutions to the primary households. So we find that financial markets include any place or system that provide the buyers and the sellers the means to trade financial instruments, including bonds, equities, the various international currencies, and the derivatives. So these markets are basically the economy's central nervous system. These markets enable both the firms and the individuals to find financing for their activities. So financial markets basically facilitate the interaction between those who need capital with those who have capital to invest. So in addition to making it possible to raise capital, financial markets also allow the participants to transfer the risk. This risk transfer is done mainly through the derivatives and hence promotes commerce in the economy in the long run. So when we try to discuss the role of the financial markets, as I have already discussed before, financial markets are markets where financial assets are exchanged. Although the existence of a financial market is not a necessary condition for the creation or exchange of a financial asset, in most economies, financial assets are created and subsequently traded in some type of financial market. The market in which a financial asset trades for immediate delivery is called basically the spot market or the cash market. Now, when we try to analyze the economic role performed by the financial assets, number one, we need to keep in mind that they allow the transfer of funds from those entities who have surplus funds to invest to those who needs fund to invest in various types of tangible assets. And number two, they redistribute the unavoidable risk related to cash generation amongst the deficit and the surplus economic units. Basically, we had already discussed these two functions in our earlier module consisting of financial assets. Now here, in terms of financial market, we find alongside with those two functions, they perform three more additional functions. The first function is, the interaction of buyers and sellers in a financial market basically determines the price of a traded asset. In other words, they determine basically the price, what would be the price of the traded asset. So as the inducement for firms to acquire funds depends on the required return that investors demand, it is this feature of the financial markets that signals how the funds in the economy should be allocated amongst the financial assets. And this whole process is basically called the price discovery process. And this process is basically a major role of financial markets. Now, secondly, financial markets also provides a mechanism for an investor to sell a financial asset. Because of this characteristic, we can say that financial markets basically offers liquidity. This is a very, very attractive feature as the owners are ensured that they can buy and sell the financial instruments in these type of markets. If there were no liquidity, the owner would be forced to hold a debt instrument until it matures and an equity instrument until the company is either voluntarily or involuntarily liquidated. So you can understand that to really provide liquidity to the economy, financial markets play a very, very important role. Thirdly, while all financial markets provide some form of liquidity, the degree of liquidity is one of the factors that really characterize the different markets. Now, when I talk about the third function, it's very important in this aspect because it basically reduces the cost of transacting in the markets. Now, whenever we talk about transactions, basically there are costs associated with transaction, and the two very important costs associated with transactions are search costs and information cost. Now, what are these? Now, search cost basically represent explicit cost, such as money that is spent to advertise one's intention to sell or purchase a financial asset. An implicit cost in terms of the value of time spent in locating a counterparty that who would like to buy my asset. The presence of some form of organized financial market basically helps in reducing the search cost. And when I talk about information cost, these are basically costs which are associated with assessing the investment merits of a financial asset. That is the amount and the likelihood of the cash flow expected to be generated. So obviously in an efficient market, prices reflect the aggregate information collected by all market participants. So students, my question to you after this is, we now talk about the classification of financial markets. Now, we generally classify financial markets in terms of various categories. Our first category is classification by maturity of claim. Under this categorization, we have two types of markets. One is called the money market and the other the capital market. Now, money market performs the pivotal role of acting as a conduit for equilibrating the short-term demand for and supply of funds, thereby facilitating the conduct of the monetary policy of the economy. A freely operating money market is a sensitive barometer of the prevailing and evolving conditions in the financial market. And ideally, this market provides a mechanism for clearing short-term surpluses and deficit. So money market is basically for short-term funds. In India, the strengthening of the money market and its structure was an integral component of the overall deregulation process of the financial system or the financial sector reforms. The instruments in use were money at call, that's the overnight one, and at short notices, that is up to 14 days, the certificate of deposits, the commercial papers, and bill rediscounting of the commercial banks. Activities in most segments other than the call money market and to some extent the certificate of deposits were few and far between. Until about the year 1987, the money market suffered from a paucity of instruments and both the interest rates and the participants were tightly regulated. Thus, the market was practically moribund. However, a series of policy measures taken from 1987 onwards paved the way for significant changes in the structure of the money market in the next few years. When we talk about the capital market under this categorization, it is basically an integral part of the financial market, and it is a market for financial assets which have a long or indefinite maturity. Capital market is again broadly categorized into two parts, into the primary market and the secondary market. In India, till the onset of the market reforms in the early 90s, raising of resources in the primary segment of the market was subject to several controls, disallowing the prices to be determined by market conditions. Trading in the secondary market was subject to opaque practices. The trading and settlement system was outdated and out of tune with internationally followed practices. As the process of price formation has to be efficient for the growth and stability of the market, it was considered necessary to orient the Securities and Exchange Board of India, which we call SEBI, to undertake the tasks of regulation and supervision. The SEBI was for this purpose given statutory powers through a separate legislation in the year 1992. We go now next to the next categorization, that is, we try to classify the financial markets by seasonality or by the seasoning of claims. So I said already that the capital market is categorized further into the primary market and the secondary market. So financial markets can be categorized by seasoning of claim in terms of the primary market and the secondary market. Now, what is a primary market? It basically deals with claims that are newly issued by the central governments, its agencies, the municipal governments, and the corporations. And the participants in the marketplace that works with issuers to distribute these newly issued securities are called the investment bankers. What are the secondary markets? These markets deal with exchanging financial claims which were previously issued mainly in the primary market. And it is also called the market for seasoned securities. So students, my question to you now is, what is the key distinction between the primary market and the secondary market? The key distinction between the primary and the secondary market is that in the secondary market, the issuer of the asset does not receive funds from the buyer. Rather, the existing issue changes hands in the secondary market and funds flow from the buyer of the asset to the seller. So, if I have to give you students the two takeaways from the secondary market, they are basically that the secondary market helps the issuer of securities to track their values and the required return, while the secondary market also benefits the investors by providing them with liquidity. We now go over to the next categorization, that is classification of the financial markets by the nature of the claim. And under this category, again, we have two types of markets. One is called the debt market and the other is called the equity market. What is the debt market? The debt market or the bond market is the arena in which investment in loans are bought and sold. There is no physical exchange for bonds. Transactions are mostly made between brokers or large institutions or by individual investors. Now we might wonder that what is the objective of the debt market? The objective of the debt market is basically development. In a broad sense, it helps to aid economic growth and development. They basically help to transfer capital from the savers to the borrowers or investors and allocate them in an efficient manner among competing uses in the economy, thereby contributing to growth both through increased investment and through enhanced efficiency in resource use. Since debt markets link issuers having long-term financing needs with investors who are willing to place their funds in long-term interest-bearing securities, a developed domestic bond market offers a wide range of opportunities for funding the government and the private sector in an economy. So, the debt market also specializes in transferring, pooling, as well as sharing risks. The debt market, especially the government securities market, serves as a benchmark for pricing other financial assets and thereby helps the monetary policy transmission. If we talk about the Indian context, the transmission from shorter to longer end of the yield curve is a function of changes in monetary policy rates, inflation levels, international interest rates, and liquidity conditions, including the SLR stipulations. Let's look at the Indian bond market, and we find that the Indian bond market has really made rapid strides in the last few years due to several initiatives which were undertaken by the state, the central bank, and other stakeholders. Although activities in the corporate bond market have picked up, the Indian bond markets continues to be dominated by the government bonds market. One of the landmark initiatives in this regard was phasing out of automatic monetization of fiscal deficit through the issue of ad hoc treasury bills with effect from 1st April 1997 through a supplemental agreement which was signed between the Government of India and the RBI on 26th of March 1997. This agreement was very important because it paved the way for funding the fiscal deficit of the Government of India through market loans, and thereby the need to develop the government bond market was really understood and perceived. Another landmark initiative in this regard was the Fiscal Responsibility and the Budget Management Act, which we commonly call the FRMB Act 2003, which prohibited RBI subscription to government bonds in the primary auction with effect from 1st of April 2006. This initiative resulted in the issuance of all government bonds in the market and improved the depth of both the primary and the secondary segments of the government bonds market. Some of the important initiatives which have been taken by the government of India with respect to the bond markets were the state government's fundraising shifting to market through an auction system, introduction of primary dealers network, introduction of when issued markets, issuance of half-yearly auction calendars covering quantum timing and tenor of securities for providing transparency and certainty to the market participants, setting up electronic platforms for primary auctions, namely the negotiated dealing system auction, which we call the NDS auction, and setting up electronic order matching platforms, the OM platforms for secondary market trade, namely the NDS OM. Consequently, the volume in government bonds market increased significantly in the Indian economy. When we talk about the equity market is the arena in which stocks are bought and sold. The market comes in the form of an exchange, that means which facilitates the traders, which facilitate the trade between the buyers and the sellers, or over the counter, which we call OTC, in which buyers and sellers find each other. The equity market also plays a very important or a pivotal role in supporting a market-based economy, since it is a bridge between providing capital to companies who require it and providing investments for investors who are seeking a return on their investment. The term encompasses all type of marketplaces such as the New York Stock Exchange, the Nasdaq, the London Stock Exchange, the Bombay Stock Exchange, and many others. Equity securities are initially listed in the markets through the IPO, the initial public offering, and are subsequently traded among people in the secondary market. The trading can be done either publicly, which are listed on public exchanges, or privately, where the issuance and trades are initiated through dealers instead of a centralized exchange. The use of dealers in the private market is the defining feature of the OTC markets. The equity markets really play a very, very important role in a market-based economy. They provide functions or economic roles like capital raising, like liquidity, and investment options. In terms of capital raising, the equity markets facilitate the raising of equity capital, and this is very, very important for entrepreneurs who have a business idea but really do not have enough capital on hand to start the businesses themselves. So banks who are debt investors, they are unlikely to provide a loan to these businesses without collateral or an abnormally high return. Therefore, it is effective for these entrepreneurs to give up a stake in their own business in exchange for the capital provided to them. Equity market allows these businesses to accept the deepest pools of capital since they do not have to seek out individual investors. The investors are brought to them through the network of investment banks and the financial exchanges. The equity markets, as I said, also perform a function of liquidity because the equity markets are basically centralized hubs for the buyers and the sellers. It is very easy to find someone who is willing to buy or sell your equity securities, and you can readily convert your securities to cash. And they also provide powerful mechanisms, pricing mechanisms, since they reflect the immediate underlying supply and demand from the millions of buyers and sellers across the globe. High demand and increased buying activities for stocks cause the price of the stocks to rise, while low demand and increased selling activity of the stocks causes the price of the stocks to decline. And the third most important function was investment options. These equity markets provide a slew of investment options for the investors. Investors can customize their risk profile and get exposure to different companies and industries by having the option to pick different equity securities. So equity markets provides a main alternative to debt instruments, which is beneficial for investors with very high risk tolerance. And the last categorization of the financial markets that we have is classification by immediate delivery or future delivery. So here that means we are talking immediate delivery is the cash market or the spot market. which is a financial market where the financial instruments and commodities are traded for instantaneous delivery. Delivery here refers to the physical exchange of a financial instrument or commodity with a cash consideration. The spot market is also known as the cash market or physical market because the cash payments are processed immediately and there is a physical exchange of the assets taking place. And the derivative market, on the other hand, refers to the financial market for financial instruments such as future contracts or options. And there are four kinds of participants in a derivative market. The participants in the derivative markets are basically the hedgers, the speculators, the arbitrageurs, and the margin traders. And the four major types of the derivative contracts are options, futures, forwards, and swaps. If we talk of the participants in the derivative market, the hedgers. Who are the hedgers? Now, hedging is when a person who invests in the financial markets to reduce the risk of price volatility in the exchange markets. That is, they try to eliminate the risk for future price movements. So, derivatives are very, very popular instruments in the sphere of hedging. It is because the derivatives are effective in offsetting the risk with their respective underlying assets. Now, the speculators are very important participants in the derivative market. Speculation is the most common market activity that participants of a financial market can take part in. It is a risky activity that investors engage in. It involves the purchase of any financial instrument or an asset that an investor speculates to become significantly valuable in the future. So speculation is basically driven by the motive of potentially earning lucrative profits in the future. The third participants are the arbitrageurs because arbitrage itself is a very common profit-making activity in the financial markets that comes into effect by taking advantage of or profiting from the price volatility that is prevalent in the market. They make profit from the price difference arising in an investment of a financial instrument such as bonds, stocks, derivatives, etc. And the fourth participant are the margin traders. In our finance industry, what is margin? It is basically the collateral which is deposited by an investor investing in a financial instrument to the counterparty to cover the credit risk associated with the investment. Thus, we come to an end of this module where we have already learned about the mechanism by which financial development can lead to economic growth. We have learned about the various economic functions of the financial markets and how they help in aiding the economic growth. And the most important part is we have learned about the various categorization or classification of the financial markets in an economy, and we have also learned about the various market participants in the process.